AM Best is out with a series of reports looking at insurers' investment results across the major U.S. segments. Here to discuss the findings in those reports are Jason Hopper, Associate Director, Industry Research and Analytics, AM Best, along with Kaitlin Piasecki and Helen Andersen, both industry research analysts. And Kaitlin, start with you. What shifts in their investment portfolios have life annuity writers made over the past year, if any?
So first I want to touch upon their net investment income, which grew nearly 8% during 2023. Bonds continue to be the largest asset class among life annuity insurers, and that's followed by mortgage loans. We also saw total portfolio yields began to improve in 2023 as we see older maturing bonds being replaced with newer, higher yielding rates. And we also see new mortgages being issued at higher rates. Portfolio yields had been on a steady decline for about the last decade due to the prolonged low interest rate environment. We're also seeing now private placements are continuing to tick up, and insurers are able to earn higher rates and yield while also improving quality. And then other asset-backed securities continue to increase allocation. In particular, we're seeing, CLOs are benefiting from the higher rates in 2023 as those assets are floating rate instruments. We are also seeing on the mortgage loan side continued growth in residential mortgages, and we're actually starting to see a pull away from office. However, problem loans, they grew notably, largely due to 90-day delinquent loans that are out there right now.
Helen, given the new investment environment, what have PC insurers been doing?
So in terms of the overall portfolio for PC insurers, we saw an increase in allocation to stocks and cash and short-term assets, and a decrease in bonds and scheduled BA assets. And within stocks, there was an increase in affiliated stocks as well as mutual funds. Bonds still make up the majority of invested assets, and within the bond portfolio, residential mortgage-backed securities were looked at favorably in 2023. There was an increase in allocation to those compared to commercial mortgage-backed securities. As Kaitlin mentioned, higher interest rates allowed for higher bond yields as bonds can be reinvested at higher rates without sacrificing quality as they have over the past several years due to lower interest rates. Now that interest rates are higher, they can get higher yields, and we actually saw an increase in credit quality with more bonds rated NAIC 1.
Jason, are we seeing the same sort of shifts among health insurers?
Yeah, John, I think there's some main themes that cut across all three segments. Health insurers' net investment income is up roughly 30%. Which is very welcoming with expected margin compression, specifically on government business, heading into 2023 and 24 through Medicare Advantage and the lower rates that they're expected there. But in any regard, net investment income's up due to strong premium growth. As already has been mentioned, the higher rates and new money yields has helped bump up yields, and total gross yield has been up over 3%. The three largest asset classes in the health sector remain the same. You have bonds that are more than half of portfolio allocations, cash and short term, being health insurers have shorter liabilities, and stock portfolios, which typically back capital and surplus rather than actual liabilities. Private placements were flat in the health sector in 2023 after continuously growing a number of years with health insurers trying to gain yield. RMBS allocations increased and are now roughly 15% of the bond portfolio. They're looked at more favorably than CMBS and other ABS, with both those allocations were down. Looking at classifications, U.S. government bonds as well as state and special revenue, I think muni bonds were up in 23. And again, back to the theme, all of these shifts within the bond portfolio have been done gaining extra yield while also increasing credit quality. We've seen a migration up to NEIC 1, up from NEIC 2, and below investment grade bonds are fairly minimal in totality, as well as a percentage of capital in surplus.
Jason, Helen, Kaitlin, thanks for speaking with us today.
Thanks, John.
Thanks, John.
That was Jason Hopper, Associate Director, Industry Research and Analytics, AM Best, and Kaitlin Piasecki and Helen Andersen, both industry research analysts. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.